In just 1 year, the world added nearly $29 trillion in new debt, pushing total global debt to $348 trillion by the end of 2025. That is the fastest yearly increase since 2020. These figures come from the latest Global Debt Monitor report by the Institute of International Finance. Now think about this. $348 trillion represents roughly 308% of global GDP. In simple terms, the world owes more than 3 times what it produces in a year. The real question is not whether debt is rising. The real question is the global economy strong enough to handle this level of debt? First, let's discuss who owes what. According to the report, total global debt now stands at $348 trillion. Out of this, government debt accounts for approximately $106.7 trillion, while non-financial corporate debt has reached around $100.6 trillion. Household debt stands at $64.6 trillion, and the remaining portion belongs to the financial sector. The most important shift is that governments are now the main drivers of global borrowing. More than $10 trillion of the 2025 increase came from sovereign borrowing alone. Nearly 3/4 or 75% of that rise was driven by the United States, China, and the Euro area. These are the world's largest economies, and their fiscal decisions shape global financial conditions. For instance, the United States remains the world's largest debtor nation globally. Its national debt has now surpassed $38 trillion, making it the highest sovereign debt in absolute terms. When compared to total global debt of about $348 trillion, the US alone accounts for roughly 11% of all global debt. This shows the key role the US plays in the global financial system, as its borrowing significantly impacts global liquidity, bond markets, and interest rate trends. In terms of debt-to-GDP ratio, US government debt stands at around 120% of GDP, which shows the country owes more than its total annual economic output. China is the second largest debtor in absolute terms, with government debt amounting to an estimate of $18 trillion. Nevertheless, the debt-to-GDP ratio of China is lower when compared to that of the United States, standing at about 90% of GDP. Despite this, China's overall debt burden increases significantly when corporate and local government borrowing are included. This is because its economy depends heavily on loans and credit to support growth. Similarly, Japan ranks among the largest debtor nations as well, with government debt close to $10 trillion. What makes Japan unique is its extremely high debt-to-GDP ratio, which exceeds 230% of GDP, the highest in the world. However, most of Japan's debt is domestically owned, which reduces the risk of external pressure compared to countries that depend heavily on foreign investors. Together, the United States, China, and Japan represent a large share of global sovereign debt. After the pandemic, private sector debt has decreased somewhat. However, government debt continues to rise steadily. This is because private companies usually borrow to earn profits, while governments borrow to achieve political and social objectives. The increase in government borrowing is the result of persistent fiscal deficits, rising defense spending, infrastructure expansion, and various subsidies and political commitments. But here's the real concern. Global debt is not just rising. If we compare global debt with global economic growth, it becomes clear that debt is rising much faster than the world's output. According to projections from the International Monetary Fund, global growth in 2026 is expected to be around 3.1%. Advanced economies are projected to grow by roughly 1.6%, while emerging markets are expected to expand at around 4%. If debt grows at 8 to 10% annually while economies expand at only around 3 to 4%, the debt burden does not shrink. Instead, it compounds. That is why emerging market debt to GDP has climbed above 235%, reaching a record high. In 2026, emerging markets will have to refinance more than $9 trillion in debt, meaning they will need to borrow new money to repay old loans. At the same time, developed countries must repay over $20 trillion in bonds and other debt. Refinancing simply means taking new loans to pay back existing ones. If global interest rates rise or the US dollar becomes stronger, problems could increase. Local currencies may weaken, foreign debt could become more expensive, investors might pull their money out, and bond markets could face instability. This is exactly the kind of situation that often leads to financial crises. Just like sovereign debt, which accounts for the largest portion of global debt, non-financial corporate debt forms the second largest share. It stands above $100 trillion. A key driver of this borrowing is a new wave of capital expenditure linked to AI data centers, semiconductor manufacturing, green energy, and efforts to strengthen the supply chain. The report describes this as the beginning of a new global capital expenditure supercycle. A supercycle means a long period of strong and continuous investment. It is different from a normal business cycle because it is driven by structural changes in the global economy, not just short-term growth. The main reasons behind this new supercycle include the global race for artificial intelligence, the shift toward clean energy, rising geopolitical tensions, and the push for economic and national security. Countries no longer want to rely too much on foreign suppliers. Instead, they are trying to bring production back home or move it to friendly nations. This trend is often called reshoring or friendshoring. The AI race in particular is reshaping capital markets, as large technology and industrial firms tap bond markets aggressively to finance expansion. As long as interest rates remain stable, the demand for bonds remains high, and global growth continues at its steady pace, the global debt levels may continue to rise without causing instability in the global markets. But in case inflation picks up, central banks are forced to raise rates aggressively, or geopolitical tensions escalate further, bond markets could face sharp repricing. And when the global bond markets experience a sharp move, the shock is not limited to the bond markets only. It is felt across the entire global financial system. To conclude, the world is now at a point where governments have become the largest borrowers, emerging markets are facing record refinancing pressures, and investment in artificial intelligence is driving corporate borrowing to new heights. At the same time, economic growth is moderate. If economic growth remains weak while debt continues to grow, the risk of financial instability could increase in the future.